Hey everybody, Tim Albrecht here, and welcome to this week's episode of the YFP podcast, where we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I welcome back to the show YFP Director of Tax, Sean Richards. We discuss mid-year tax projections, what they are, why they matter, and specific examples where a mid-year projection can help someone optimize their tax situation. We discuss the importance of adjusting withholdings, ensuring record keeping is up to date, common pitfalls that business owners and side hustlers can avoid with a projection, and tax considerations with student loan payments coming back online in a couple months. You can learn more about YFP Tax's services for both individuals and businesses by visiting yfptax.com. Again, that's yfptax.com. Sean, welcome back to the show.
Thank you. It feels like I was just here, but it also feels like it was just tax season yesterday. So I think things are kind of all sort of blending together at this point, which is understandable given, the rush of everything. And now that we're in summer and all this other stuff going on, but I love being here. So appreciate you having me back on.
So we're post-tax season. You've got a new baby in the house. We're gearing up for mid-year projections, which we're going to talk about on this show. So you should have tons of free time right now, right?
Yeah, I really haven't been doing a whole lot of anything, just kicking back on the couch and kind of watching a lot of TV and stuff. It's baseball season, so you get these games that you can just sort of put on the background and sleep all day. That's basically what I've been doing. Yeah, nothing really going on at work, at home with the new baby and the other baby who's under two under two right now. So yeah, a lot of free time. So if you got anything for me to work on, please send it over.
I'll keep that in mind. 2 under 2 is intense. Yeah, I remember I shared with you our oldest two are separated by 17 months, and our other two are a little bit further spaced out. And 2 under 2 is the real deal. So kudos to you and your wife for making that happen. And as you were talking about yesterday, I can remember very well, all of a sudden baby comes in and your oldest, who still is relatively young, looks much older all of a sudden, right?
Yeah, she does look much older, but she also, and I swear it's not just a comparison or I shouldn't say the comparison, but now we have a little one at home, so she seems older, but I swear overnight she went from being 1.5 to being 2 and getting those terrible 2s right in there because, man, it's like you said, it's intense, but it's really exciting. It's awesome. I mean, I couldn't be happier with everything, but it's an exciting challenge is what I would say for sure.
Well, last time we had you on was episode 309. We talked about the top 10 tax blunders that pharmacists make. That was coming off of the tax season. And here we are, end of July. People may not be thinking about taxes in the middle and dead of the summer, but we're going to hopefully make a case of why tax is important to consider, not just in tax season, not just in the summer, but really year round, right? And that's our philosophy, our belief at YFP Tax, that tax planning, especially for those that have more complicated situations, when done well, is exactly that. We're doing year-round planning. We're proactive. We're not as reactive. And we're going to talk about an important piece of that year-round approach, which is the mid-year projection today. Before we discuss that mid-year projection and some of the details and reasons of doing that, Sean, just define at a high level by what we mean by that term, right? We throw that around internally all the time. Mid-year projection, all of our listeners certainly are familiar, hopefully, with filing taxes, but maybe not as familiar or have experience with a mid-year projection. So tell us more.
Yeah, I mean, it really is. I mean, if you kind of look at what it says, it's a projection, right? You're projecting out what you expect to have at the end of the year. And really what it is kind of like putting together your tax return now based on what you think it's going to be at the end of the year. So obviously there's some variables there and some uncertainty with everything as it always is with forecasting and budgeting and that sort of thing. But that being said, given that there are uncertainties, there are things that you want to kind of keep an eye on. So yeah, it's really just sort of doing a projection of your finances for the year and really kind of coming down to what we think your tax return is going to look like. Are you going to have a bill? Are you going to have a refund? And then looking at that and kind of working backwards to say, what can we do to tweak things?
So if we go a layer deeper on that, Sean, why do one? What's the case to have one done? What's ultimately the goal that we're shooting for here?
I think the goal, and I mean, you kind of alluded to it before saying people probably aren't thinking about taxes right now, and that's totally fair. I don't expect people to be thinking about taxes right now unless you're maybe me or somebody in similar shoes as me, but I mean, the goal is that a lot of people get stressed out about taxes, and I don't blame them. It's it's one of those things where I joke that when you're in high school, you learn that the mitochondria is the powerhouse of the cell, but they don't teach you how to file your taxes and do basic finance things, right?
Preach it.
So what generally happens is, you're kind of, I don't want to say sweeping things under the rug, but you're not thinking about taxes, or, it's not top of mind throughout the course of the year. Then you get to the end of the year and you're doing your return, and it's all look back, all historical, and there's not much you can do at that point, right? So if you're filing your return next year for this year and you have a big refund that, it's nice to have a refund, but you got all this cash all of a sudden that you could have been doing stuff with last year, or vice versa. You get to the end of next year, or the end of this year, you're filing next year, and you have a huge bill, and whether you have the cash ready to pay it or not, it's nothing that anybody wants to have, right? So the idea of doing the projection now is that you're not getting to a point where you're stressed out thinking, what could have been, what should have been last year. You're getting ahead of those things and saying, hey, right now things look great. Don't have to do anything. Or, things don't look as good as they could be. Let's tweak that. Or maybe not even any of those. It's just, hey, right now, we have status quo, but there's some things that are changing in my life. I have a new job, or I'm thinking about opening up a rental property or something, and making sure you kind of have those ideas in your head now, as opposed to, again, in April and handing it to your accountant saying, I forgot to mention I bought that house last year. Whoops.
Yeah. I think with most things, and we'll talk about some specific examples here, but most things, right, when we shift to more proactive planning versus, reactive, and obviously for those that have more complicated situations, the more the proactive planning is going to help. And we'll talk about that in more detail as well. But anytime we make that mindset shift, there's an opportunity for peace of mind as well, right? I think a lot of people I talk to, Sean, when I say, hey, what are the opportunities? Are you thinking about opportunities to really optimize taxes as a part of your financial plan? Everyone's like, yeah, I want to do that, right? I want to make sure that I'm paying my fair share, but no more. But then actually executing on that, it's like this cloud of, not exactly sure what to do, how to best navigate it. And I think that is the opportunity with the year-round planning. And ideally, we'll make the case of why it's important to have a CPA, in your corner, throughout the year as well. But I think that peace of mind part is just such an important piece, especially for many pharmacists I know that have this lingering question of like, am I doing everything that I can? Right. There's the cleanup part where, maybe we've made mistakes, or, we don't want to have a big bill or refund. But then there's the second layer of that, which is that nagging feeling of like, is there something else I could be doing? Right. And I think that's one of the values of the projection.
Yeah. And I mean, the peace of mind thing, like you said, is that I feel like going back to the whole kind of high school idea of how they don't teach these things to a lot of folks, right? And I remember getting my first job out of college, and I had an accounting and finance and even tax background from college. And you start getting these things. Hey, do you want to do an HSA? Do you want to do 401k? There's Roth and traditional. There's IRAs and everything. And people are like, I don't know what any of this stuff is. I'm just, I'm getting a nice paycheck for the first time now. I know I want to save, but I don't know what any of this stuff means. And it becomes, kind of overwhelming to have all these things happen. And like you said, you don't want to come to the end of the year and say, I wish I had done these things because I didn't know that, there were opportunities for me to save here and there. I just thought that I was doing the right thing by putting my money in this savings account or in this account. So yeah, I think, again, the uncertainty and just sort of lack of general tax knowledge in the country and world, can be stressful, and not having to worry about that is very important for peace of mind and general sanity.
And to be fair, right, the process, is more complicated than it probably needs to be. And because of those complications, like there's some of the ownership and work on us to be planning throughout the year. One of that piece, of course, would be the mid-year projection. Sean, right. I have to admit, prior to really, building our tax team over the last several years, a mid-year projection was something that was never on my radar. And so my question for you is, should everyone do a mid-year projection? Is this necessary for everyone?
I think it is. I think at the very minimum, anybody who's paying taxes and has a job and has to file a tax return at the end of the year should be doing some level of projecting the end of the year to make sure that there's no crazy surprises. So you might be listening to this and saying, hey, my situation's really simple. I filled out my W-4 when I started my job. I don't have any crazy stuff going on. I don't think I really need to do this. But again, we keep kind of coming back to this peace of mind thing, and that could be great. And, maybe your return last year was fine, and, there's not a lot of stuff that's changing, but there's always changes to the tax law. I mean, the W-4 system changes all the time, and I know it's not what people don't even realize. Hey, can I claim 1 or 2 exemptions? That's not how it works anymore. So, there's always changes to the law and changes to things going on. So even if you think your situation is pretty simple and doesn't apply to you, just doing a quick check to make sure, hey, there's not going to be any crazy surprises. And again, with something like that, you're not necessarily going to be saying, oh, am I taking advantage of all the laws that exist out there and all the different ways to maximize my tax savings? But you just want to make sure, hey, am I going to owe a ton of money to the IRS at the end of the year, or am I going to get a ton of money back that the government was borrowing from me for free for the entire year? And what I would say is, if your situation is simple, you can even just go on the W-4 calculator that the IRS provides. It's, not perfect. Please, no one from the agency come and chase me down. It's not a perfect system. And there's, a couple different things that can happen there. You might, go through the whole process and get a bad answer and then say, well, what am I supposed to do with this? It says that I'm going to owe a lot of money, but I don't know how to fix that.
Yeah.
Or you might just use the tool, and like I was alluding to, you might just get frustrated with it and say, what are all these questions they're asking me? I don't understand any of this stuff. Why is this so complicated? So it is a good starting point, I would say, especially for those with simple situations. But I would just advise to be wary when you're doing it, that it's not a perfect system, and it definitely can be a little confusing.
Yeah, and I'll be honest, and admittedly, I'm a little bit impatient and want these tools to always be better than they are. I've been on the IRS W-4 calculator tools, and I've gotten annoyed, frustrated playing with that, and I've left. So I think the decision tree, to your point, like for people that have a very simple tax situation, can they do it themselves? The technical answer is yes. There's an IRS calculator, that's going to give you some basic information. The follow-up question is, do you want to do it yourself? And then the follow-up question to that is, if you have a more complicated situation and or you're looking for more input of advice based on the output of that number, right? That's really where some of the assistance and help that can come in from working with professionals. So,
exactly.
we'll link to the show notes to the IRS W-4 calculator. Certainly people can play around with that, which I'd recommend regardless of, working with someone else, just have a better understanding of the different inputs in these numbers and, hopefully to get the conversation started as well.
Yeah, absolutely.
Let's talk about some common examples where a mid-year projection can help, right? So you're in these conversations every week with our year-round tax planning clients. We talked about several of these on episode 309. And again, we'll link to that in the show notes. That was the top 10 tax blunders that we see pharmacists making, which we recorded after the tax season. But I think there's an opportunity here really to bring to life, not just the academic or theoretical side of why a mid-year projection may be necessary or what it is, but some actual examples where a mid-year projection can help. So I'll turn it over to you to talk through some of those common places where you see this having value.
Yeah, sure. I would say the number one thing probably is just adjusting withholdings in a to put it in 2 words, it's adjusting your withholdings or adjusting withholdings, get rid of the "your" in there. But it's, I know, I swear I'm better at math than I lead on when I do these things. But yeah, adjusting withholdings. Like I said, the W-4 system changed a few years ago. Some people don't even realize that. Some people, probably set up their withholdings 20 years ago when they started a job and haven't done anything since then. And, that might work for some folks, but the way that the W-4 withholdings works now with the IRS is, if you get a new job or your spouse gets a new job or, you have changes in salary and everything, your withholdings might not be working the way that they did in the past. You can also have other life events that sort of throw a wrench into that. You can get married, have kids. Even if you are married, you can kind of consider, and we'll talk more about this when we get into some of the other blunders, but consider whether you're going to file separately or file jointly, and that changes the way you do withholdings and everything. So that's probably the number one area. Like I said, not withholding properly at the end of the year is almost certainly going to cause a problem, whether it's you're over withholding and you're getting that big refund back, or you're under withholding and you have a big bill. That's, the biggest and easiest way to kind of course correct. If we do a projection and we see that that's the case, submit a new W-4 to your employer. All of a sudden you're withholding appropriately. We can do a catch up to get you to where you need to be, or make an estimated payment or something like that. But I would say that's the number one thing. And it sort of encapsulates everything else. Not entirely, but just because, holding down a W-2 job and getting the taxes taken out of your paycheck is the way that most folks are paying the IRS. So I would say that's probably the biggest one.
Let me jump in real quick, Sean, before you move on to other common examples, because that one is so common. And I just want to highlight when you think about the situations where withholding adjustments are necessary, right? You mentioned individuals getting married, adding dependents. I think about people that are moving different locations, they're buying homes, new jobs, changes in income. These are things we see all the time, right? And the key here is we want to give ourselves as much time as possible to make a pivot or a change on either side of this. So we find out that, hey, because of X, Y, and Z, we're anticipating a big refund. All right, let's start making some adjustments so we can put that money to work in other parts of the financial plan. If we find out that we're going to have a big liability due, well, we just bought ourselves some more time to kind of budget and plan before that payment's going to become due and to make those adjustments. And that's so important because this is the phase of life where we least want a surprise, right? Especially on the O side of things, right? Getting married, moving, new job, new house, expenses that come with that. We want to avoid as much as possible these surprises that are going to put a wrench in the other part of the financial plan. So I think withholdings, adjusting withholdings, we all are familiar with. You take a new job, you fill out the paperwork, but I think we can lose track of that throughout the year or when those job changes aren't happening. So just wanted to drive that home further.
The two things I would add to that are, so the big thing is that, people are always excited about getting their refunds, right? If you get a big refund back, it's cool. It's almost like you found a $20 bill in your pocket after it went through the washing machine that you didn't know about. But would you rather find out about a refund in April and get the cash back now, or find out now that you're going to be getting that refund back and then be able to actually put that in a savings account or deploy it somewhere where you can get a return on it, as opposed to getting that cash back in a few months with nothing, right? Yep. So it's kind of like a net present value sort of thing, to borrow a finance term. But would you rather get $10,000 in 6 months or $10,000 now? And the answer is now, right?
Especially with where interest rates are on high yield savings accounts and other things.
I mean, right? any way that you can get a little bit of extra cash now as opposed to tomorrow or any time in the future is better. And then the other thing that I would say, and I keep going back to the whole W-4 withholding thing, is that you might be, perfectly fine at your job and nothing has changed. When I say perfectly fine, status quo, right? You're working the same job, standard kind of raises every year, nothing crazy going on. But with the way the W-4 system's working now, if your spouse goes and gets a new job and they update their W-4, but you don't do anything on your end, that can mess things up.
Good point.
People don't realize that. They're thinking, hey, you go and claim the exemptions that you've always claimed in the past. We have 1 kid or 2 kids or whatever it is, but that's not the way it works anymore. So even if it's not you that's had changes to your life specifically, you have to think about your entire family and everybody who's landing on that tax return at the end of the day. Yeah. So that's one thing that definitely slips some folks' minds, I would say.
Great stuff. So adjust withholdings, I'm hearing you loud and clear, probably the most common thing that we see.
Yep.
And it's one of those things that big impact, but not a huge amount of work to be done to make this pivot. So that's a low-hanging fruit. Talk us through other common examples where a mid-year projection can really help.
One good one is, this is another kind of, hey, this comes up every year with tax and filing is record keeping, right? So we get to the end of the year, you purchased a rental property and you're excited about it, you're getting some cash and everything, and now it's time to file taxes. And instead of just your typical, hey, Sean or Mr. CPA, here's my W-2 and here's my 1099 and I'm good to go, right? You have a rental property now. There's a lot of things that need to go into something like that. And you might not be thinking about, some of the ins and outs that happen with that. I mean, if you have improvements to your property, those are treated differently than if you have electricity costs that go into your property, or, there's a lot of different things that people don't think about. And it's not even that people don't think about it. It's, you don't want to be scrambling at the end of the year to say, I got to go get all those receipts and get all my finances together and all that stuff and try to get pulled all together when everybody's trying to all do the same thing. The extent you can kind of get ahead of that now is great. Obviously, from getting your ducks in a row and helping your CPA out at the end of the year, but also kind of going back to this whole idea of am I going to owe at the end of the year? Mm-hmm. So if you're able to come to me or whoever you're working with and say, hey, here's the settlement statement for the house that I just bought. here's all the details, here are all the closing costs and everything. Can you build that into my projection? And the answer is absolutely yes. I'll run that through and see what your rental is going to look like for the year, or anything. It doesn't have to be a rental property. You could be, starting a side business or doing anything like that. But just kind of having the stuff together gets you ready for the end of the year, but also allows us to be able to, again, do those calculations to say, hey, that rental that you built or that you just bought and you just did that big addition on, well, that's going to save you in depreciation this year. So you're going to get a refund back. Let's redeploy that cash. Maybe you put it back into the rental property. I don't know, but now we have the opportunity to do something with it.
I'm so glad you mentioned this one, right? Because we are seeing a larger and larger part of our community that's jumping into real estate investing. We're seeing a larger percentage of our community that's jumping into a side hustle or a business, and just so important. And we'll talk about other things for business owners here in a moment to consider. But what we're trying to avoid, not that this ever happens, Sean, right? But we're trying to avoid is, hey, we get to tax filing and you ask for the information come February and March. And it's like, oh yeah, by the way, I bought a rental property 8 months ago. Can you figure this out right for me tomorrow? So, again, proactive planning.
And now that example, hey, I bought a rental property last year. I forgot to mention it to you. People might be rolling their eyes saying, okay, well, if you work with an accountant, who is not going to tell their accountant about their rental property? Sure. That's totally, that might be unrealistic to some folks. I get it. But we've seen plenty of circumstances where folks have been, say, living in their house for 20 years and they decide, I'm going to rent out a couple rooms in the house this time for the first time.
Yeah.
And hey, that's awesome. Get some side income, be able to write off some of the expenses. It's great. You've been living in this house for 20 years. We need to start taking depreciation on this house for rental. We need all the costs for the last 20 years that you put into that thing. So, I know now some people might be sweating saying, oh boy, that's a lot of look back, right? But it's something that's going to need to get done anyway. So would we rather get ahead of it now or have me looking for that in April, right?
Yeah,
good stuff. A little bit of a different example there, but hopefully trying to get some people thinking about things.
Yeah. And I think, Jen, just a proactive, when people are starting, I'm thinking about a lot of individuals in our community that are new real estate investors, right? First property. And so I'm not sure, number one thing on their mind, especially if they're not yet working with an accountant, would be thinking about a lot of the record keeping and get ahead of the proactive tax planning. Now, if they've worked with an accountant or they are multiple properties in, different situation, right? The trigger goes off. Similar to if you've been in business for a while, the light bulbs go off more often of like, oh yeah, got to talk to the accountant, about this. What about opportunities for tax optimization, right? One of the things I think about with a mid-year projection is, hey, we've got an opportunity, again, proactive, not reactive, to really look ahead and say, hey, are there things that we can be doing to pay our fair share, but no more, and optimize our overall tax situation? Tell us more here.
Yeah, and this one's good because it applies to everybody in a very broad spectrum of things, depending on what you have going on in your financial life. So that could be something where it's as simple as, hey, I'm working a W-2 job. My spouse is working a W-2 job. We don't have any kids, nothing else really going on. What can we do to optimize our taxes given our situation? And that's a perfect example of where it's a awesome time for your accountant and your financial planner to sort of work together because, there's always the kind of idea of, hey, we want to maximize our tax savings, but we have a life. We need to be able to have cash to pay our bills and do other things too, right? So it's a very delicate balancing act of, I want to maximize my tax savings, but at the same time have enough cash to do all the things that I need to do. So it's a perfect time to work with both your accountant and financial planner to say, hey, should I put more money to my HSA? Should I put money into a 529 plan? Should I, what kind of things should I be doing with my extra cash? That opportunity cost of $1, right?
Yep.
But you can also have more, I say more fun kind of examples because it's the ones where you can, really think about different opportunities that are out there and how to take advantage of these laws. So an example of that would be, say you have a side business and you need to buy a new vehicle. There's so many different things that you can do with that. I could spend an hour, maybe we'll have a separate podcast on buying a vehicle and the different tax implications of doing so. But got a side business. Hey, how much are you going to be using this thing for business? Are we able to take a Section 179 deduction? Is it a type of vehicle that would qualify for something like that? We have all these new EV credits with the Inflation Reduction Act. Are we going to be able to take advantage of all those? What if we use it for business? Can we still take the credits and everything? So, that might be a little bit of a nuanced example to some folks, but it's a perfect example in my mind of how something that is, maybe not a day-to-day thing that happens, but something that a purchase that folks are going to need to make in their life, most likely, you can really use that as an opportunity to say, hey, I got to do this anyway. How can I also maximize my tax savings at the end of the day? When you're sitting in a car dealership and the people are trying to sell you on all these different tools and upgrades and everything, you're probably not thinking, I wonder if I can save on my taxes with this purchase. But it's always possible. So
I'm going to give credit to our community. I think they are asking that question, Sean. So
they are for sure. I'm getting that one a lot. In fact, I'd challenge you to find another community that's as interested in the EV craze right now, which is awesome, I have to say. And cool. Really, folks should be looking more and more into that because of those credits I just mentioned. They're just every year getting better. But I love it. I mean, every year I'm seeing more folks buying EVs or buying used EVs and getting the credit now. It's good stuff.
So as we continue talking about some of these common examples where mid-year projection can help, the other one that I think about, Sean, that we're seeing a lot more of is, business owners, especially new business owners, right? So, maybe they aren't thinking about, tax considerations, withholdings, making sure they're making quarterly estimated payments if they have to. So what's the opportunities here with the business owners as it relates to the mid-year?
Well, this is kind of where I say, take all the examples I was just giving you and throw them out the window. Not exactly, but when I was talking about how adjusting your withholdings is such an important part of this entire thing, I shouldn't say throw it out the window because they do definitely go hand in hand. But if you're a business owner, you have a side gig, you're making money kind of doing that, you're almost certainly not getting W-2 income from that job. Or I shouldn't say you're almost certainly not, but there's a good chance you're getting income from that business that is not having taxes withheld on it. And that is probably the number 2 or number 1.5 blunder that we see where folks have these businesses, they're not setting aside cash. They get to the end of the year and are excited to give me the P&L that shows, hey, look at all this money I made. And then I say, that's awesome. You owe some money in taxes. Do you have that ready to go? And it's like, ooh, I kind of wasn't thinking about that. So, it goes hand in hand with the withholding, but it's really just, hey, let's look at the business right now. Where are we mid-year? What's your P&L look like to date? What kind of expenses do we have coming up for the rest of the year? I talked about these EVs and things. How can we think about maximizing your savings there to reduce your business income and be able to say, all right, well, at the end of the year, we're expecting that we're going to have $10,000 in business income. Being able to say that now and make your estimated payments up to the IRS is not only a good thing, it's actually what you're required to do per the law, right?
Yep.
So that's where I would say that a projection isn't a nice to have, but an absolute necessity if you're a business owner.
Yeah.
It's something where you can't really say, hey, I'll think about this later, or let's just hope the chips fall in a good spot. You really need to be doing a projection now to say, what am I going to owe? Do I need to pay estimated taxes now? Should I have been making estimated quarterly payments up until now? And, maybe I need to do a little catch up to hopefully not have a penalty at the end of the year at this point. But again, to any extent you're able to get ahead of that now, where I'm looking at the calendar and it says July versus December, January, April, it's always better.
Especially, Sean, I'm thinking about those new business owners again, where, often there's the excitement around the growth. There's a reinvesting of any of the profits to try to continue to grow the business. And so if we can identify some of this mid-year, sometimes that even informs some of the business strategy of like, hey, are we charging appropriately? And what's the service model look like? And making sure that accounting for taxes as I look at kind of the bottom line and making sure we've got cash on hand to do these other things. And of course, not being caught off guard, as you mentioned as well.
Yeah, and that's to kind of give I don't want to say a very specific example because it's something that we see very, very often. It might seem specific to some folks, but I think a lot of people here will resonate with this. But big one is business owners, especially first-time business owners, paying themselves.
Yes.
A lot of folks will do that, and then, they're maintaining their records and saying, hey, my net income is going to be pretty low at the end of the year, so I don't have to worry about estimated taxes or anything like that. And then we get to the end of the year, you provide your P&L, and I say, actually, those $10,000 that you paid yourself, it's not really a salary expense of the business because it's just a sole proprietorship. It's actually just taxable income to you, whether you took the cash or not. that can be very eye-opening and in a bad way for a lot of folks at the end of the year, right?
Yep.
And it's something it's not entirely intuitive to think of it that way. You might be thinking, well, I work for the business, I'm paying myself. Isn't that an expense? But in the eyes of the IRS, depending on the way you're set up, it may or may not be, right? So getting ahead of that now and having your accountant maybe give you that bad news of, hey, that money is actually, something you're gonna have to pay taxes on at the end of the year now, so you can plan ahead, is always better than getting that during your tax review meeting in April or May.
And I get it for the small business owners. We were there several years ago. For the small business owners that are just getting started, you're looking at working with a CPA. It's another expense in the business. I get it, right? But it's going to pay dividends, when you talk about making sure you've got the right entity setup, classification, separate conversation for a separate day, making sure we're withholding correctly, getting financial statements set up correctly, making sure that we've got the books in good order. These are all going to be critical components to building a healthy business. And you're not going to get all of it right as you're getting started. And that's okay. I think some of that, is natural, but, making that investment and building that in as an expense of the business from Jump Street as a part of just doing business to make sure you've got all of that in order is going to be, really, really important.
Right. It's not just a nice to have, like I said, it's something where that should be part of your plan from the get-go when you're building this out. And people might be thinking about, well, hey, isn't this podcast supposed to be about doing a mid-year projection? Why are we talking about, what my business looks like? That's kind of different than my taxes, right? But like I kind of said in the beginning when I was explaining what a projection is, you're really just basically doing your tax return for the end of the year with the information that you have on hand.
Yep.
And one of the lines right there is, hey, what's your business income? So if you want to do a correct projection for your taxes, you're going to actually have to do a projection for your business as well. So even though it might seem like it's going a little bit too far or you might not be able to connect those dots there, it's something that it's absolutely intertwined and something that you need to do for sure.
And last, but certainly not least on our list, what would be a YFP episode if we didn't talk about student loans? We've got student loans coming back online here in a couple months. A lot of questions that are coming up related to the restart of those payments. We've talked at length before about how tax and student loans can certainly be intertwined depending on one's loan repayment strategy. So what is the value or potential value here, Sean, for someone that's optimizing or looking to optimize your student loan repayment strategy and where the mid-year projection can play a role?
Yeah, I can't take any paternity leave anymore because when I do, it seems like they announce all these student loan changes and everybody's all excited and wants to talk to their CPA, and I'm sleeping on the couch with the kids and everything. So lesson learned there. But yeah, absolutely. And this is another example that I would say is a perfect example of where mirroring your tax strategy and working with a financial planner or whoever kind of manages the finances in your household and does the budgeting and everything is absolutely instrumental in making all this kind of work together. So yeah, I mean, with student loans, there's a lot of different things that can happen there. And people have been asking me about, hey, so I've heard that you can file separately or file jointly or do these different things to maximize, or I should say, maximize savings, minimize my loan payments or my spouse's loan payments. And yeah, I mean, that is something that you can make that decision when you're doing taxes to say, hey, am I going to file separately or am I going to file jointly? But it all kind of goes back to that idea of withholding and making sure that you know how that works, right? So if most of our clients who aren't doing the student loan thing that are married generally are filing jointly, and that's kind of what you're told from the get-go, right? Hey, you get married, you file jointly, you get all the benefits of doing it. It's the best way to do things. So for someone to come and tell you, hey, actually going forward, filing separately might be better for you. Not only is that kind of shocking for some folks to hear or like a complete change of what they've kind of been told throughout the course of their life, but it also changes how they need to do withholdings and how they need to think about, credits that they might have, whose return is that going to land on? And, does one spouse withhold a little extra and recognize at the end of the year, they might get a refund that offsets their spouse's tax bill or something like that. So there's a lot of things that you want to make sure that, again, even though you think that might be something you can make that call at the end of the year, just given all the different stuff going on with the loans, being on top of that now and trying to minimize those surprises is always a better thing to do. And to the extent you can mirror your tax strategy with your financial plan, it's always just the best way to do things.
Great stuff, as always, Sean. As we wrap up this episode talking about the mid-year projection and the role it can play in some of the areas where it can effectively be utilized, let me encourage folks to check out the resources and services that we have available, yfptax.com. We'll link to that in the show notes. We have individual year-round tax planning led by Sean, as well as for those that do own a business, bookkeeping to fractional CFO, as well as some of the business tax planning that's associated with that. So again, yfptax.com, you can learn more. You can schedule a call with Sean as a discovery call to learn more about that services and whether or not that's a good fit. So Sean, thanks so much. Appreciate it.
Thanks, Tim. Talk to you soon.
As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.